Good morning, friends. Welcome to the live session of a revision of the topic of foreign exchange exposure and risk management. I, CA Ashish Gupta, Deputy Director, Board of Studies, welcomes all students. In this series of our hybrid lecture form, I hope you must have gone through the 6th lecture that has been web hosted and along with the assignment. Although there was some error in the assignment, I will discuss with you. I will get it corrected very soon. So students, in today's session, what I will do, I will basically go through, or I will revise whatever you have studied in the previous 6 lectures. If you have any query, you are free to ask me. Now, student, when I talk about this topic, one sec. Foreign exchange exposure and risk management. Now, student, it is one of the very dynamic topic of our CS syllabus. The reason is that the coverage of this topic is very wide, and it can be very huge. But however, keeping in view since it is only one chapter in our syllabus, we have kept the coverage very limited. So whatever the two aspects are covered, one is how the foreign exchange rates affect an organization and how we has this risk. Because in your chapter number 2, there was one topic, financial risk, and in this financial risk, there are currency risk as one of the key element. So here, how we manage this risk or how we has the risk, because risk is inevitable in any business. It is inevitable in every aspect of the life. So we cannot avoid the risk. We have to manage the risk. That is the moot point. And students are saying good morning. Good morning all. Namarta, Bhaskar, Koshki, and Virat. Good morning, students. Now, students, let us start about this topic. Now, when I talk about the risk management, it basically say how we has the risk. But before we discuss what is the foreign exchange exposure. Now, student, if I talk you about if I go through the whole topics of the syllabus, so it starts with the introduction. Then it comes your Nostro Vostro account. Then exchange rate quotation, broad heading. Under this, there are many subheadings. Then it comes exchange rate forecasting. Then it comes exchange rate determination. Then it comes exchange rate theories. That covers purchasing power parity and IRP, interest rate parity. Then we come foreign exchange market. Who are the participants? Then we come to type of exposures. There are 3 types of exposure. One is transaction, translation, then economic exposure. Then we come to last, hedging currency risk. Under this, there are two techniques. One is internal techniques. That is done at your organization level. No outside parties are involved. Then it comes the external techniques. Okay, in this outside parties are involved. So basically these are the broad classification of the topic of the foreign exchange. What are the topics are covered? Now, student, let us start our discussion on the same topic. Janvi is asking, sir, please explain question number 3 to 5 of the assignment, foreign exchange exposure and risk management. Okay, student, let me check. First, I will discuss with you the overall coverage. Then, of course, if possible, I will. Okay, Janvi, don't worry. These questions are relating to some topic. Don't worry. I will give you the coverage. Don't worry. Sumit is asking, this Namaste full chapter will be like, just coverage of the will be the full chapter. Today I will discuss each and every topic quickly and in a brief manner. Now, student, when I talk about the foreign exchange, when I talk about the term globalization, so I think even a small child may be aware of this term. Why? Because in one way or other way, now our life is very affected, much affected by the foreign exchange. The days are gone, because when I'm talking about you the 90s, somewhere about before 90s or some whereas in the 94, before 90, 94, 93, you can ask your parents. At that time there was nothing like that globalization terms are there, because at that time this term was evolving. स्टूडेंट्स, अगर मैं बात करूं टर्म ग्लोबलाइजेशन की, तो आज की दुनिया में हर एक छोटे से छोटा बच्चा भी इसके बारे में जानता है. रीजन क्या है कि जो टर्म है ग्लोबलाइजेशन, इससे हम कहीं ना कहीं अफेक्टेड हैं किसी भी तरीके से. अगर हम मोबाइल की बात लेते हैं, तो देखिए मोबाइल में क्या चिप डलती है, चिप में अगर देखें तो वो इम्पोर्ट होती है. और सिमिलरली अगर हम बात करते हैं आईटी सेक्टर की, तो इंडिया में आईटी सेक्टर बहुत ऊपर पे है. और दैट्स वाई दिस इज अ रीजन कि हमारी जो रेवेन्यू का एक सोर्स है इंडिया को, वो आईटी सेक्टर से है. तो स्टूडेंट्स, नाउ आईटी सेक्टर इज वेरी इंपॉर्टेंट फॉर इंडिया. दैट्स व्हाई बिकॉज because a major part of our export proceeds come from the IT sector. So that's why term globalization has become important. Now, prior to somewhere around 90s, 1993, I can say that. Before that, normally the rates were regulated by the RBI. Post 1993, we can say that in a post-liberalization era, the rates are started to be determined by the market forces. Of course, RBI is a regulator. RBI is a regulator of foreign exchange, but still it is a free play of the market. अगर हम 1993 से पहले की बात करते हैं, तो फॉरेन एक्सचेंज लगभग थोड़ा सा कंट्रोल्ड मैनर में चलता था, जिसका रेट डिटरमाइन करती थी आरबीआई. लेकिन बाद में यह रेट आरबीआई फ्री मार्केट की फोर्सेस से डिटरमाइन होने लगा. व्हेन वी टॉक अबाउट दैट इट हैज कम इनटू द फ्री मार्केट प्ले, free you can say that there is a play of the market forces, then it start becoming more volatile. And it is, you can imagine, you can know that every day, I think every say 1 year or once in a 1 year, in the news comes the rupee has become very weaker. This is because now when the rupees become the weaker, the petrol, because India import at least the 80% of its requirement of the petrol from the outside India, and for this they have to make the payment in foreign currency, that is dollar or whatever with the euro. So for this, ultimately the outflow is more there, and that's why there is a kind of inflation, because transportation becomes costlier, and as a result goods are becoming costlier. So ultimately it impacts our economy as well. So foreign currency plays an important role. Now, when I talk about the organization from organization perspective, please remember, of course, economic perspective is there, macroeconomic, but when we look at it from micro aspect point of view, it should be very important it is very important to note that we have to hedge ourselves. So hedging is another part, and first we start discussion with our basic. Now, when we talk about the exposure, goods worth $10,000 to say USA. Now today's spot rate is say 80 per dollar. Now suppose after that, because normally what happens, there is a time gap between the shipment, raising the invoice and receiving the actual payment. So the difference between the time, during this difference of time, the currency rate can be fluctuate. Suppose by the time you receive the payment, rupee has become stronger and the rate has come 78 per dollar. Now earlier you were expecting a remittance when you were invoice the goods, you were expecting that remittance will be rupees 8 lakh, but however due to becoming rupees stronger, the remittance is 7 lakh 80,000. So of course this 20,000 is the loss. Now suppose on the other hand, if this rupee rate has become 82, then what will be the situation? Of course, this is profit, but student, risk is always means the variation from the expectation. So sometimes student says, sir, risk means always loss. No, student, please note that risk always means variation from the expectation. What you have estimated, it's the variation from the same. So basically that we have to hedge this risk. The hedging of this risk is more important. Now another comes the translation risk. Basically this is not a practically, you can say it is a kind of a risk. It does not pose any bigger problem. Rather, you can say this risk is a kind of a accounting risk, because it is relating to mainly accounting aspect only. For example, if you are, because there is a separate standard for the same. I think it is AS11, and in IFRS also the Ind AS there is another standard. Now I'm just simple saying, suppose you have made investment of $1 lakh when the rate of dollar was rupees 65. Okay, now today this investment is standing in your balance sheet and the rupee has become weaker, and today's rupee stands at rupees 80 per dollar. Now this asset will be worth rupees 80 lakh. So the variation, because when you have purchased this, the year then you have acquired the asset, the balance sheet, you have shown it at a 65 lakh. Now today's its valuation is 80 lakh. Now this adjustment of the 15 lakh is a basically translation exposure, but it does not affect the cash flow in real term. It does not affect our cash flows. It normally varies on the accounting aspect, whereas this affects our cash flow. Cash flow here is affected. So it is important for us. Now another category is the economic exposure. Economic exposure basically means, it basically, you can say it impacts the company indirectly. For example, I give you a bit recently, I think day or 2 days before, I was reading the newspaper. There was a news that yuan has maintained its status, and due to which Chinese yuan has maintained its status, due to which Chinese goods are becoming cheaper. So India is importing more goods. So because yuan is basically that currency, because China has controlled its currency, they have kept the yuan at very lower value. Of course, the real values are higher, but they say that if we really revalue the dollar, Chinese yuan, it will become costlier and their product will become costlier in the world. I just give you a very small example. Suppose now say today $1 is rupees 65, or we can say plainly speaking rupees 60 per US dollar is there. Okay, right? Now say there is one product which cost $1 per kg, that is exporting from India, that is being exported from India. Now what happens? Suppose tomorrow the rupee become weaker all of a sudden, and it becomes rupee 80 per US dollar. Now what will happen? The demand for the Indian goods will be increased. Why? Because now with rupee $1, how much you can buy, how much you can get import, the quantity you can get imported is basically 4 by 3, that is 1.33 kg. So this increase is basically will impact the demand of the goods, and the demand will be increased manifold. So this is very important. Economic exposure, it does not affect the, you can say directly, but indirectly it affects the company's growth, and it can be reverse also. If the rupee has become stronger, the demand for the Indian goods will be become. So here the one very important concept is elasticity of demand is also plays a very big role. Why? Because if you have read in your economics paper, elasticity of the demand means with a change in the price, if the demand is changed, it is called elasticity. Sorry. Higher the elasticity, higher will be the change in the demand. So what happens if the demand is elastic? Only then it will be impacted. If the demand is inelastic, whether rupee depreciate, whether rupee appreciate, there will be no change in the demand. Now, when we start about the Forex, one important topic comes, one topic we start with the, you can say, first topic is our quotation. Quotation is very important in the Forex topic. It is, you can say it is a beginning. Because there are generally two type of quotations. One is direct, another is indirect quotation. Okay, indirect quotation, 1 unit of foreign currency and varying units of quoting or domestic currency. On the other hand, indirect quotation, 1 unit of home currency or domestic currency and varying units of foreign currency. Very small example, say if $1 is equal to rupees 50. Okay, so if I write it like that, rupees 50 oblique USD, it is a direct quote. Okay, and if I write it, now when we have to convert direct quote into indirect quote, the rule applies is inverse. Inverse rule apply here. What inverse rules applies here means we can convert, so indirect quote is equal to 1 upon my direct quote. Accordingly, 1 rupee divided by 50, it becomes US dollar 0.02 per rupee. Okay, student. Now I hope it is clear to you. So this is basically the manner of quotation. Now, sometime a common doubt among the student is like that, sir, in the examination, sometimes you will see the quotation like that. Say I'm just quoting the same example, rupees 50. Okay, and sometime in the books you may see that the convention is same 50. One sec. So both these conventions are correct. In the Indian books maximum, we follow this approach, whereas in foreign authors, we have approached these books. Now, the problem, of course, when we are solving at our home, the question it does not have any problem. The problem comes when we are in examination. In examination, there is a problem that, so how we handle this situation. Now, answer is that, student, please note, because I just tell you, in foreign books, this rule is followed generally, and because they say it is kind of an extension rule. They say it like an extension rule. They say that generally it is used in case of euro and dollar versus euro, dollar, Great Britain pound versus this. So now, very important question, students. When in examination, if you got confused, which convention we have to follow? Now, student, a very logical reply here is that now you have to guess. You have to guess in question what convention we are following, because if rupee oblique USD has been given, of course, there are the chances are most that there will, since rupee is a weaker currency, so in one USD there will be more rupees, not reverse. It means we cannot assume that 1 rupee will be equal to 50 USD dollar. So it is very important to note that you draw the conclusion from the figure given in the examination. Students, जब मैं कोटेशन की बात करता हूँ, ये एक बहुत कॉमन डाउट आता है बच्चों के दिमाग में कि सर हम कैसे जज करें, क्योंकि कई बारी कोटेशन हमको ऐसे दे रखी होती है, रुपी और यूएस डॉलर करके दे रखी होती है, और कई बारी यूएसडी और रुपी करके दे रखी होती है. इसके बारे में स्टूडेंट्स मैं आपको ये कहना चाहूंगा कि एक चीज हमेशा याद रखिए कि अगर आपको ये कंक्लूजन ड्रॉ करना होगा स्टूडेंट क्लास में, एग्जाम में, कि हमने कैसे इसको निकालना, उसके लिए तरीका सबसे बढ़िया यह रहता है, आप ये देखिए कि $1 में 50 रुपए तो हो सकते हैं, पर $1 में 50 डॉलर होना असंभव है अभी के हालात को देखते हुए. तो आप वही कोटेशन अगर जो फिट बैठ रही है आप उसी को फॉलो कीजिए. Another student, I important to point discuss here that whenever we use the quotation, it can be symbol based or it can be ISO code based. For example, for US dollar, normally this symbol can be used, or we can use this ISO code. Similarly, for rupees, INR. Okay, for Great Britain pound, like symbol is like that. Clear? Okay, Swiss franc, normally we use this symbol, or Swiss franc, we use this code. Great Britain pound, and another is Japanese yen. For example, there is a Japanese yen. We use this symbol. Okay, for euro, very important. Euro symbol is like that. We use this. So these are your ISO codes. Let me make you very clear. It is our ISO code. There are 3 digits. There is a list on the website also, and even we. So this is a mainly difference. So in some questions you will see this symbol. In some question you will see this symbol. In another you will see these codes. So both are interchangeable. It hardly matters. But better in whatever form the question has been given, you give the answer in the same, using the same symbol or codes. Now next thing important term regarding the code is European code. Okay, so American code says per unit of domestic currency. So hence, normally whatever way quotation has been given, that is per US dollar. Okay, they say our currency, because America has been a dominating effect, American dollar. So normally they follow this approach. In the European quotation, per unit of foreign currency. So that is a more important European quote, and so you have to see which quotes have been given in the examination, and because normally we will judge it is a European quote. These are only for theoretical point of view. Normally, this no, it can be used so frequently that you will never encounter any problem. Now, when I talk about very important aspect, another important aspect is one second. One second. Now, let us see. Another important aspect is what is the structure of the Forex market? We can say that the Forex market is a four-tier market. On the top of it, it comes the central bank. Because central bank is you can say regulatory, not as a regulator, but rather it purchases and sells the foreign exchange also to control the rate. Very important, because I think 2 years back I have read in a newspaper the RBI is also indulging future trading to control the rupee, because they normally control the foreign exchange rate. They cannot let it beyond, cannot leave it on the market forces. Another layer is brokers. This category does not normally exist in India. Then it comes the commercial banks. This is an important category. These are also called authorized dealers. In India, normally they are considered as a market makers, because maximum sale or purchase of the foreign exchange is carried out from them. Then it comes the last category. It comes the user retailer. They are also called retailer. Exporters, importers, travelers, all use the foreign exchange. So this is the last category, and or even the immigrants, the who are selling of their business, etc. in India, and or they are surrendering Indian passport. They have surrendered the Indian passport and migrating to the world, to the another country for the life. So these are category. Even nowadays, very important category, students. Because nowadays, in our time when we were student, hardly any one or two students used to go to the foreign university for the studying. But nowadays, I think even every third student is planning to going to outside India for studying, etc. So this is the basic structure of our, you can say, the overall structure of the market, foreign exchange market. Now, when I talk about that the banks are the market, commercial banks are the market maker. Now, what does it mean? Market maker means they give both rate, buying rate and selling rate. Now, student, I give you a very small example in this regard. For example, it is a very funny example. Now, suppose if I go to the market now, since tomato is a very expensive nowadays, suppose if I go to the market and ask for a vendor that I want to purchase a tomato. So vendor says to me, it is 1 kg 100 rupee. Okay, but as a consumer, what I say, customer or a consumer, I say there is another vendor on the corner of the street who is selling at rupees 80 per kg. So in that case, this vendor, what it may be the reply? Okay, sir, you sell me I will buy the same tomato at 80 rupees if he is selling at the rate, because tomato is I have purchased myself from the wholesaler at rupees 90 per kg. So in that case, I will say, okay, I am purchasing it. But here in foreign exchange, the situation is not that. स्टूडेंट्स, मैं आपको एक एग्जांपल देता हूं जो आपको ये मार्केट मेकर का कंसेप्ट क्लियर करेगा. इसको हम ड्यूल कोटेशन भी कहते हैं. जब आप हम जैसे आपको एग्जांपल देता हूँ कि जैसे मान लीजिए टमाटर आजकल बहुत महंगा है. मैं एक वेंडर के यहाँ गया और मैंने उससे कहा, सब्जी वाले से कहा कि आप 1 किलो टमाटर का क्या रेट है. उसने कहा 100 रुपए पर किलो, 100 रुपए 1 किलो. एज ए मेंटेलिटी ऑफ आवर एज ए कस्टमर, आई से कि पीछे एक वेंडर है, वो सब्जी वाला है, वो तो 80 रुपए किलो दे रहा है. तो ये सब्जी वाला मेरे को कहता है कि आप ऐसा कीजिए सर, 80 रुपए में मैं खरीद लूंगा आपसे, आप लाके दे दीजिए. बट मेरा क्या है, मैं वहां पे बेचने नहीं गया हूं, मैं तो खरीदने गया हूं, तो मैं 100 रुपए में खरीद कर आ जाता हूं. नाउ स्टूडेंट, दिस वे in our but in foreign exchange market the scenario is completely different. Here bank can sell you to a foreign exchange, as well as bank can buy the foreign exchange from you. So accordingly, when a bank is buying from you, it is called bid rate, and when bank is selling to you, it is called ask rate. Now there is one confusion, or you can say one point, sir, how we identify which rate is bid rate and which rate is ask rate. Now student, there is a golden rule to remember this. Ask rate will always be greater than bid rate. It is important to note, bid rate will always be lesser than ask rate. The difference between these two rate is called spread, and that is mainly the income of the bank. Okay, student? One second. Okay, student, now let us proceed further. Now there is another term attached with this, is interbank rate, and another is merchant rate. Very important. Interbank rates mean the rate among the banks themselves. One second, I think it is coming very bold. Okay, I think there is some issue. 1 second. At which bank carries out dealing among themselves, and very important, the pips, or you can say decimal point, in which quotation are given is up to 4 decimal point. Okay, student, it is very important. The decimal quotations are given is in a 4 decimal point. Then it comes the merchant rate. Merchant rate means the rate that is given to the quoted to the customer. Now I give you very small example how you can understand what is the difference between the merchant rate and this. Now what happens, because here I will discuss with you the concept of margin. Now suppose Mr. X is an importer. Okay, he goes to his bank and asks for say rupees 1 lakh dollar. Okay, now what happens, the very good principle, one of the very important principle of the banks is that they never keep the money with themselves. What they do, they buy it from another bank and sell it to you. Now the bank say there is a bank A, the banker has bank A. Now what does it, the bank A search in the market, what is, now Mr. X asks for the quotation, ki how much I will have to pay. Okay, so what does the banker do? Bank A looks in the market. Okay, so when you start looking in the market, so it will use the interbank rates. Now say the rate is per US dollar 84 point say 5. Okay, now this is the interbank rate. Now interbank rate will, of course I am just giving you, interbank rate will be like that. I am just clearly writing it, rupees, sorry, the interbank rate, say it is like that, or I can say, 1 second. Okay, now here what happens, if the bank buys, the rate will be this, and if bank sell, it will be the rate. So it is an interbank rate, it is a bid rate, it is ask rate. Now when the banker will quote to the customer, he will charge some margin money, he will charge some margin money. So banker says, okay, I will quote rupees 84.15. Now when he will charge the margin, say it is 0.25%, it is very normally very minuscule. Okay, these margin charges are for the administration expenses. These margin are for normally administration expenses. Now somewhere the amount is coming like that, 21213. Now amount comes 84.721213. Okay, so the banker will quote that I will charge rupees 84.7213 per USD from you. Now, student, very important to note that now suppose the amount was since 1 USD dollar, 1 lakh USD dollar. So he may be given the quotation up to 4 decimal point, but it might be possible that if the importer has asked for only $10,000, okay, then in that case the bank may have given the quotation like this, okay, or they may have given the quotation like this much, because normally last 2 digits, 4 decimal point, these are called pips. Pips equal 1 pip is equal to point in point form 1 divided by 10,000. So here they may say that, okay, if you are asking for this, now if you are asking for this, I will give you the 4 decimal quotation. Now student, one very important point I will like to hear important. There is FIDI rules for quotation. FIDI guidelines, you can say that. Normally FIDI guidelines or practice follow. In this case, what happens? Now this question comes, how we round off this? There the normally quotation has to be rounded off into this form. Okay, you will see in some questions the question in the multiple of this 0.0025. Now question rises, in that case what will be the quotation? 84.7225, because higher will be the there. Now had the quotation amount has come say 84.7212, then bank may have charged 84.7200. So basically there has to be multiple of 0.225, 0025. Okay students, even that case bank can charge, even in case of it is a 3, even bank can charge 7200, because normally they are considered as beneficial for the customer, which are the beneficial for the customer, they can say. So the quotation can be like that, 84.7200. Okay student, one important point when we talk about the margin, very golden rule, in ask rate we add it, in bid rate we deduct it. Now there is another categorization. There is another categorization of quotation. One is cash rate, then spot rate and forward rate. Cash rate means immediate delivery. Spot rate, delivery after 2 working days. Okay, and forward rate means if delivery is after after more than 2 working days. Now I need to discuss you with the term forward, because in the topic of derivative, you must have gone through the topic of forward very well. Now, when we talk about the foreign quotation, when we give the forward quotation, now question comes how we quote the forward rates. Okay, this can be absolute or swap point form. Because normally what happens, swap point form is normally used because it is considered that the prefix is the same. Now I just give you a very small example. Say spot rate of USD dollar is, say like that, it is 84.510 oblique, you can say that it is 84 point, we can say it is 610. Okay, now say 3 months forward, the rate like is that okay student, the rate is like that. So here you can see we have given the rate. So in the swap point form, what will be the rate? And here it will be only given by the premium. Or so normally you will see that there is a increasing order in case of a premium. Sorry. So if it is has been given in this form, then you can consider it is as a premium. They are considered as a premium. Their ascending order, it is premium. If descending order, it is discount. So another important point is regarding this, how we give the quotation. So forward quotation we give in this manner. Student, just make it consider, I am just correcting it. If it will be given like that, 210, sorry, it will be given like that, 2000, and it will be given like that, 2100. Just point, no zero, no zero. So this can be manner, it can be given. So you can judge easily that how the quotations we can interpret the quotations. Okay. Sorry, just remove it. I'm just saying you just forget it because they will be given in a point form. Only it will be added. Now, student, question comes. Now, question is, why forward rate are normally at premium or discount? Why they are not stable? Now, student, the answer lies in three theories. One is purchasing power parity. Another is interest rate parity. And then Fisher effect. International Fisher effect. Now, what this theory says, this theory assumes that there is a free flow of goods among the countries. There is no restriction, there is no transaction cost, etc. Now, in that case, what happens if I say today, say this is a rate. Okay, now suppose just I say we can say today, say one particular category of apple is costing $2 in USA, and same category of apple is costing rupees 160 in India. Now, this theory says, as per purchasing power parity, it says like that. Suppose in USA the inflation rate is 5%. Okay, and India the inflation rate is 10%. Now, what happens after 1 year? The same apple will cost USD $1 in USA, and same category of apple will cost 176 rupees in India. Now, if this happens, then what will be the rate justified? The rate will be $83.81. Okay, now this figure we can also find one other way around. Forward rate is equal to spot rate into 1 plus inflation in domestic country plus 1 plus domestic inflation in foreign country. Accordingly, rupees 80 into 1.10 divided by 1.05. So that way also we can get the same figure. So this is called purchasing power parity. So now from due to this reason, this happens that the currency become weaker. The country which have a higher inflation, its currency is likely to become weaker. Now, another topic concept is that interest rate parity. Interest rate parity, the logic behind this interest rate parity says, if there is a difference in the rate of interest, the country, then there will be a change in the interest rate. How we change the interest rate take place? Now I let you know. Suppose you have $1,000. Today's spot rate same. I'm just considering same. Today you invest $1,000 in USA, where the rate of interest is say 5%, 2%. 5% is very higher, keeping in view the USA. Equivalent amount in Indian rupees $80,000 is invested at 5%. So after 1 year, this amount becomes US dollar $1020, and this amount after 1 year accumulates rupees 84,000. So it says that after 1 year, what will be the parity? The parity rate will be computed like this. The justified rate will be computed like that. Okay. So the justified rate will be, or we can compute, use the formula also. So the logic of formula is that spot rate into 1 plus interest rate in domestic country, 1 plus interest rate in foreign currency. So accordingly, what happens? Our spot rate is this plus 1.05. Okay, so the answer will be the same. So accordingly, the logic is that the country who has the higher interest rate is, their currency is likely to be at a discount. Their country currency is likely to, the country whose interest rate is lower, their currency is likely to be stronger, or it is likely to be at a premium. Now, this interest rate parity theory gives to the concept of cover interest arbitrage. This gives you the concept of covered interest arbitrage. Now, what is covered interest arbitrage? Just I explain to you. I'm just writing here again. Now there is a question in your 14. I think it is in your study one. Let me check. It is your in your assignment. There is a question number 14. If you look at this question, this is based on this covered interest arbitrage. Okay. And this is basically, you can say it is based on the interest arbitrage. I will explain you the difference between what is covered and uncovered interest arbitrage. स्टूडेंट्स, आप क्वेश्चन नंबर 14 देखिए अपने स्टडी में, इसमें असाइनमेंट में। जिसमें आर्बिट्राज अपॉर्चुनिटी के बारे में पूछा गया है, वही क्वेश्चन हम यहां डिस्कस करते हैं ब्रीफली, क्विकली। उसमें आपको मैं बताऊंगा कवर्ड और अनकवर्ड में क्या फर्क होता है। Now, इसमें in this question it says there is a Canadian dollar rate. This is Deutschmark rate. Per Deutschmark. This is Canadian dollar. Okay. And this is the interest rate in Deutschmark. Interest rate is 8%. Whereas in Canada, the rate of interest is 10%. Okay, again, 3 months rate has been given to you. The rate is 0.67. 1 per dot mark. Now here it says, is there any arbitrage opportunity? We have to find the same. How we can find the same? Because we can use the 3-month interest rate in Canada, in Germany, since 10% per annum. Here it is 8% per annum. So 3-month rate is here 2.5%. Here it is 2%. Now we apply the IRP and compute the rate. Of course, student, please compute the rate. You carry out the calculation along with me. It will help you to grasp the concepts. Now the rate will be justified 669. Okay, student. Now 3-month forward rate has been given to you. So it means there is an arbitrage opportunity. The rate should be 0.669. If it has been 669, then there is a no issue. It means there is a parity exists. Now question arises, then if how do we know arbitrage opportunities? Because there is a mismatch between these two rates. Now the question will arise, what will we do? How interest rate arbitrage works? It works in a manner that you borrow in one currency or you invest in another country. You borrow in one country and you invest in another country. Now let us see how we determine that where we have to invest. Now student, this is called parity line. Here the discount or premium is given. Here interest differential. It says if the interest difference and discount and rate premium between the currencies is on this line, then there is no scope for interest arbitrage. Now in the given case, if I compute the discount on the Canadian currency, the discount is coming like that. Per annum I can take. The discount is coming 3%. Okay. Now on the other hand, interest differential per annum is 10% and 8%, that is 2%. Accordingly, the 2% somewhere lie here and 3% difference in it. So accordingly, the point will come like here. Okay, student. Now this is a situation. If we are below the parity line, it says arbitrage outflow from the country. Okay. Inflow, arbitrage, inflow in the home country. Now here, very clearly we know that the discount is 3% and interest differential is 2%. The point is lying here. So accordingly, what will we do? We will borrow in Canada and invest in Germany. Okay, student. Now I'm not going to solve the question completely here because it is seeing the time constraint here. So I hope it is clear to you how we compute the same. This is what is the logic behind IRP. Now another theory I am covering here. Please note. International Fisher effect. Now this theory says that whenever you calculate the interest rate, you have to consider the inflation also. As per this theory, this is a topic I normally discuss with you. Nominal interest rate will be equal to 1 plus real rate of interest into 1 plus inflation rate minus 1. So this, as per this theory, our rate of interest should give the compensation for the inflation. So this is the basis only of this theory, and this is normally frequently used in most of the questions. We have seen that. Now I am coming to another important aspect. Now, student, when we talk about direct, say bid and ask rate, there comes another question comes, that is how we derive there is some kind of a, we can say that relationship between bid and ask rate and direct and indirect quote. How we can derive the direct and indirect quote from the bid and ask rate. Students, जब हम बात करते हैं बिड और आस्क रेट की, तो इसका एक रिलेशनशिप होता है डायरेक्ट एंड इनडायरेक्ट कोट से. हम वो कैसे कोट का रिलेशन एनालाइज करते हैं, लेट अस सी. इसके लिए हम जनरली एक टर्म यूज करते हैं, implied inverse quote. फॉर एग्जाम्पल अभी मान ली assuming that today our rate has been given like that 83.50. मान लीजिए डॉलर का आज हमको ये रेट दे रखा है बिड, ये कौन सा रेट है? बिड रेट। और ये कौन सा रेट है? आस्क रेट। दिस इज अवर डायरेक्ट कोटेशन। यदि मान लीजिए मेरे को यही कोटेशन इनडायरेक्ट कोटेशन लेनी है, तो कैसे लिया जाएगा? इसके लिए 2 मिनट सोचिए, हमने डिस्कस किया हुआ है, फिर मैं आपसे डिस्कस करता हूं। यहां पे जो मैंने टर्म लिखी है implied inverse quote. Student, I mentioned the term implied inverse quote, that is will be followed. Now here we can say like that, we reverse it. So the indirect quote will be US dollar per Indian rupees so you can see here it will become the bid rate, it will become ask rate, and accordingly the quotation will be okay student. So this is implied inverse quote. So this is and this will be followed very quick, you can say very oftenly. In most of the question I use this quote, and when I will discuss the next concept of a cross rate, then it will be more clear to you how we interpret this rate. स्टूडेंट ये बहुत इंपॉर्टेंट कंसेप्ट है और ऑफनली यूज भी करा जाता है। और अभी मैं क्रॉस रेट का जो कंसेप्ट डिस्कस करूंगा आपसे आगे, वह इसमें सबसे ज्यादा उपयोग होगा इसका। नाउ नेक्स्ट टॉपिक आई एम डिस्कसिंग क्रॉस रेट, and in this I will discuss 3 questions that student were asking. Now student, the question rises, what is the cross rate? Cross rate can be defined as a rate where it can be defined as a rate that is derived from the rates of the currency that is not for the currency that is not available in the domestic currency. Now students, it is very important to note that normally what happens, the quotations for the currencies which are frequently traded are available easily. And say if I ask that normal, what are the frequently traded currency, then it comes like that: US dollar, euro, Great Britain pound. Nowadays Chinese yuan is also becoming popular, Japanese yen, and Even then, if you can suggest any currency that is coming to your mind, then it will be very, very better. Euro, Japan, US dollar, Great Britain pound. Even sometime there is one another currency that is more in use nowadays. Singapore dollar is not right thing. Even Australian dollar can be also be easily available. So we can say that sometimes the quotation may be available for these currencies easily. But suppose if we ask for a currency, let's say for Thai baht, the direct quotation may not be available. So in that case, what happens? For Thai baht, we can use the cross rate rule. Okay. Now in the your assignment, there is a question. This is question is relating to your Hong Kong dollar. So it is an also an example. The question number 3 of your assignment, the student is asking. So in this question, now how we determine the cross rate, that is important to discuss here. Now student, when we before I discuss this question, there is another kind of a concept that is come into the picture, that is called triangular arbitrage. Okay, student. Now, in this context, please refer the question number 13 of your study material. The study material must be available with you. Please refer the bring out this question. I am giving you 2 minutes for reading this question. Okay, student. In the question, you have been provided with some quotations. Okay, you have been provided with some quotations. And just let me bring out also the question. Just 2 seconds. Now quotation is like that. USD INR 48.3, that is at Mumbai market. And then it is Great Britain pound INR, that is at in London market. Now Great Britain pound USD. Here it is 1.6231, that is at New York market. Now student, we can see that from these two rates, cross rate for the Great Britain pound and USD can be find out. Okay, students. So, of course, in the class, the concept has been discussed with you. So now I am just saying whether there is arbitrage opportunity exists. Let us see. If I derive the cross rate from it, then the rate comes 77.5 52 divided by 48.30. The rate comes like that. Okay, student. So it means there is an arbitrage opportunity because this rate is not matching with this rate. So it means there is an arbitrage opportunity. Now in this, what we do, we carry out the round transaction. How we carry out the round transaction? Since we have $1 lakh with us, we get them converted into INR. We have dollar this much. Okay. From this INR, what we do? We buy the Great Britain pound. Okay. So the rate will be okay, student. The converted amount will be okay, student. Now these are again converted into USD. Okay, the amount will be reached about okay, student. So this will be the arbitrage profit. So you can see when there is a mismatch between the rate, there will be a profit. Okay, student. I hope the how we use the triangular arbitrage must be clear to you. This is a question not covered in the study material and not covered in your assignment, but it is in your study material. Okay, student. Now next, I'm coming to the question number 3 of your assignment. First, 1 second. In this question, it says that one second, let me bring out the solution. Sorry. 1 second, 1 second. In this case, says that the bank sold Hong Kong dollar 1 lakh to its customer at the rate of rupees. I'm just quickly here doing the question only just to make you clear the concept. Don't worry. Now itself itself it covered into the London market. When the exchange rate was, now in the London market, you see the rate is like that. $1 is equal to Hong Kong dollar 8.4409. This. Okay, now local market rate is equal to rupees 62.7128 oblique 96, or we can say 62.9624. So these two rates are there. Now, student Sushant sir has discussed with you how we have computed the rate, but now I discuss the methodology that I used in my own case, and that is, as I discussed with you, that will use the concept of, this is an implied inverse quote. स्टूडेंट सुशांत सर ने आपके साथ ये क्वेश्चन का आंसर डिस्कस किया हुआ है, मैं उस मॉडस ऑपरेंडी पे नहीं जा रहा, मैं आपको अब यूज करूंगा जो इम्प्लाइड इनवर्स कोट का जो कंसेप्ट है वो यहाँ पे कैसे यूज होता है वो मैं आपसे डिस्कस करता हूँ. स्टूडेंट मैं इस क्वेश्चन को जब करता हूँ तो मैं अपने दिमाग में लाता हूँ कि मुझे अब अपने कस्टमर को $1,00,000, मैंने $1,00,000 हांगकांग डॉलर बेच दिए, तो मैं अल्टीमेटली क्या लूंगा, मैं उसको लेने के लिए अल्टीमेटली लंदन की मार्केट में जाता हूँ. लंदन की मार्केट में ये रेट अवेलेबल है, तो अब ये क्वेश्चन उठता है कि मुझे एक हांगकांग डॉलर लेने के लिए, मैं यहां पे दोबारा लिखता हूं, या मैं नेक्स्ट शीट पे आता है, वन सेकेंड. यह अभी का रेट है. अब मैं पहला इसमें रूल लगाता हूं कि जिसमें मैंने बिड और आस्क को कन्वर्ट करता हूं डायरेक्ट से इनडायरेक्ट कोट में. स्टूडेंट्स नाउ आई कन्वर्ट bid rate, I convert the direct quote into the indirect quote, means for acquiring $1 Hong Kong dollar, now the quotation will become in a $1 Hong Kong dollar, it will be like that. एक हांगकांग डॉलर लेने के लिए और बेचने का क्या रेट रहेगा वो मैं इससे निकाल देता हूं. अब देखिए यहां पे अगर मैं इसकी बात करता हूं तो जो रेट आता है 1 डिवाइडेड बाई 8.45, okay student, for acquiring $1 Hong Kong dollar, this much of dollar I have to surrender. Okay student, so अब मेरे को देखिए, मैं एक हांगकांग डॉलर लेने के लिए मेरे को इतने यूएस डॉलर देने पड़ेंगे. अब मैं क्या करता हूं, डॉलर लेने के लिए मैं इंडिया आता हूं. जब मैं डॉलर लेने इंडिया आता हूं तो डॉलर का रेट यहां पे क्या है, जब मैं इंडिया आया तो मेरे को $1 कितने का मिल रहा है, 62.9624. तो अब देखिए इतने डॉलर लेने के लिए मैं क्या करता हूं, इसको इससे एक 1 सेकेंड, हाँ 62.96, तो इतने एक हांगकांग डॉलर लेने के लिए मुझे इतने डॉलर देने पड़ते हैं, और एक डॉलर देने के लिए मुझे इतने रुपए देने पड़ते हैं। तो इतने हांगकांग डॉलर देने के लिए मुझे कितने देने होंगे, अब मैं इसको इससे कंप्यूट कर सकता हूं। ओके स्टूडेंट, थोड़ा सा राउंडिंग ऑफ का डिफरेंस आएगा अगर मैं इसको सीधा करता हूं 96 पॉइंट से, या इसको इससे सीधा मल्टीप्लाई करता हूं। ये लॉजिक समझाने के लिए किया है मैंने आपको ना। ये स्टूडेंट, हियर इज सम डिफरेंस ड्यू टू राउंडिंग ऑफ। आप राउंडिंग ऑफ पहले नहीं करेंगे, सीधा बाद में करेंगे। स्टूडेंट प्लीज नोट दैट, डोंट गेट इट राउंड ऑफ इन स्टेप वन, you round it on final figure, just you compute here. So accordingly our answer will be, ओके स्टूडेंट। सो ये एक अप्रोच मैंने और फॉलो करवाता हूं बच्चों को कि आप ये देखिए, आप ऐसे एज्यूम कीजिए कि मुझे एक डॉलर लेना है हांगकांग बाहर लंदन में, तो उसके लिए मुझे कितने डॉलर देने पड़ेंगे, और उतने डॉलर देने के लिए मुझे इंडिया में कितना खर्च करना पड़ेगा। तो स्टूडेंट आई थिंक इस क्वेश्चन को करने के बाद आपको कंसेप्ट क्रॉस रेट का बिल्कुल क्लियर हो जाएगा, और इसके बाद आपके सारे क्वेश्चन इजीली हो सकते हैं इससे। जो आपके 4 और 5 हैं उसमें आप सेम लॉजिक लगाइए आराम से, और आपका आराम से आंसर निकल जाएंगे। ओके स्टूडेंट, विद दिस वी आर गोइंग फॉर ए शॉर्ट ब्रेक ऑफ द 10 मिनट्स, आफ्टर दैट वी विल रिज्यूम द सेशन। अशोक जी। Welcome back, students. Now continuing our discussion on the revision. Now I discuss with you the next topic that is most important. This is hedging of foreign exchange risk. Now, when we talk about this hedging, there are two broad categories: is internal techniques and another is external techniques. When we talk about the internal techniques, the first it comes the invoicing in domestic currency. Now, what does mean the domestic invoicing in domestic currency means? Now, student, it is very simple logic. Suppose I just give you a small example. Although there are no that much of practical or numerical question types are there, except in one or two old RTP, I have mentioned this kind of a scenario where you can give the quotation invoice, give the invoice in your own currency. Now, for example, just I give you a very small example. Now, say you are exporting goods to say any country. Say you are exporting goods to say Australia. Of course, you cannot invoice in their currency. So normally we carry out the invoicing in a international currency, say US dollar. Suppose you are exporting the goods worth rupees $1 lakh to any company in Australia. Now today, the dollar rate say is rupees 82. So of course, the amount will come after 3 months. Now, as we discussed in previous example, okay, we can do like that. Instead of this 80, I am just taking the rate of 80. 82, I am just taking the rate of 80. That will be make it easy. Now, after 3 months, if the payment comes, we are exposed to foreign exchange risk because our invoicing is in US dollar. Now, what I do, instead of invoicing in US dollar, the invoice is raised in the Indian rupees. Okay, now today's spot rate is 80. So the invoice is raised is 80 lakh. Now the headache of, or you can say the onus of foreign exchange risk will be shifted from the importer to the exporter, because now after 3 months, it will be the headache of the Australian company, that Australian company, to arrange this 80 lakh rupees for you and remit it to you. So it means ultimately the foreign exchange risk is shifted from you to the, or from importer to that company who is exporting. So this is very but it is very important to note that this concept is normally works only in case where there is a my mistake. Here I am just my mistake. We are the exporter and the Australian company is importer. I am just used interchangeably. My mistake. Now here the burden of exchange rate has been shifted from exporter to the importer. Now, student, please note that the invoicing in the home currency can be made only when you have any monopolistic poly position, because nobody will ready to bear the exchange rate risk. Next, it comes the leading and lagging. Now, in leading and lagging, what happens? It is kind of a accelerating the payment. Okay, it is the delaying the payment. I'll just give you a very small example. Suppose you have imported goods of rupees 1 lakh and today's spot rate is rupees 80. Now payment term is like that. After 3 months, you have to make the payment. Now suppose your concern is that, or your estimation is that about after 3 months, the rupee is likely to weaker and it will become 82 rupees per dollar. Now in that case, what will you do? You will try to accelerate the payment. You will try to accelerate the payment. You will ask your exporter, or you will ask your exporter that I want to make the payment at the earliest. Why? Because say you will say that I will make the payment after 1 month, because you are expecting that the rate will be like 81 rupee per dollar. In that case, my outflow will be only 81 lakh rupees. If I wait for this 3 months, I am likely to lose 1 lakh rupee more because of this higher payment. So in that case, you are accelerating the payment. Similar way, suppose you are an exporter. Now you are an exporter. Okay. Now, as per RBI guidelines, suppose if RBI comes with the guidelines, whatever the remittance, because generally RBI comes out with these guidelines time to time, because to strengthen the position of control, the regulate the position of foreign exchange in India. As per RBI guidelines, within 15 days, you have to convert inward remittance in Indian rupees. This is the guidelines of the RBI. Okay, now in that case, what happens? When this guideline comes, now it comes to your mind, oh, it is a guideline are there. Now suppose you have invoiced $1 lakh and the payment is likely to come in, say, I'm just saying 1 month. Here I'm taking only 1 month. Okay. Now say today's spot rate is 80. You are expecting that after 3 months, the rate is likely to rupees, spot rate, the rate is likely to 80 rupees, 82 rupees after 3 months. Okay. Now what happens? You assume that you anticipate that if I receive the payment after 83 months, then I will be at the benefit, because I will have a straight gain of 2 lakh rupees. And suppose if you are anticipating that after the rate is likely to be, say, 1 month, rupees 81, then you will say you will lose ultimately 1 lakh rupees. So this is 1 month realization. This is 3 month realization. So you will ultimately lose rupees opportunity gain of 1 lakh rupees. So in that case, what you will do? You will try to postpone the payment, keeping the default risk in the mind. You can say to you can give the grace period to your exporter, your importer, okay, you can make the payment delayed because you are more interested in delaying the payment because as a rupee is becoming weaker and weaker. So this is called leading and lagging. Then another technique comes netting. Now in netting, what happens? It is kind of a bilateral netting because suppose there are two parties, one party is A, another party is B. Now suppose in a transaction, A has to give US dollar 1 lakh to B, and in another transaction, B has to give $80,000 to A. Now in this case, what happens? If they two transactions are carried out separately, then it will involve exchange rate difference, how it will be exchange rate loss, because ultimately, because both parties has to approach their banker for this amount. So again, ultimately, so again here, B will be at loss, A will be at loss. What they do, they net off this transaction, and under the net of arrangement, A will pay only rupees US dollar only 20,000 to B. Of course, it will be less. It will give a benefit of the exchange rate losses to the. It will be very beneficial for both the parties because ultimately this will has to buy from their bank. This will has to buy from their bank. Then ultimately they are transferring. Ultimately now in that case, the amount will be 1/5 of the same, and B will have not to approach the bank. So this is called netting. So this is called bilateral netting. In multilateral netting, this is normally carried out in case of MNCs. Now suppose I'm just exhibiting here. You can imagine your mindself. There is a company, a parent company is in USA. Now there is another subsidiary in UK. There is another subsidiary in Germany. Then there is another subsidiary in France. Now there may be some transaction okay. Now there may be some transaction in between them. So in that case, what happens? They can set off the transactions among themselves. One second. One second. They can set off the transaction among themselves, and it may be possible that the situation might be, suppose if I write here, this is a situation, it might be possible that if they start settling the transaction, so it can be even reduced. You will see that it can also be reduced. So this can be the possible. This is called multilateral netting. Now another is matching. Normally matching means when we match the receipt with the payment. Whatever we are exporting, we are getting imported the amount of the same amount. So by this we can do the matching. Price variation means normally we vary the price and adjust the inflation factor, in exchange rate factor in the price itself. Then there is very important term, that is ALM, asset liability management. Now this term is more important in context of the banking business, where normally asset liability management, because in the asset liability management is more important in concept in context of the interest rate risk management, because in interest rate risk management in bank, especially in bank, as on asset side they have a lending, and liability side they have a borrowing, so both are interest sensitive. So because they have to see how we have to manage so that their interest impact. So similarly this exercise can also be do in the foreign exchange. They can see that our assets and liabilities are matched in a same currency, so that there are impact. Because suppose I just give a very small example. Now I just give you a very small example. Suppose a company has borrowed say $1 lakh, okay, and acquired an asset of $1 lakh. Okay, suppose on a one particular year, this is the rate. Now on the liability side, the amount will be 80 lakh. Similarly, on asset side, the amount will be 80 lakh. So that way, suppose not tomorrow, in another year, $1 becomes rupees 82. Now in that case, our liability will also be shown at 82 lakh. Kaushiki, you are saying what was matching means we are matching received with the payments. You can say that. Okay, if you are an exporter or importer as well, you will try to match your import with your export, so that only it can be set off. Similarly here, it will be rupees 82. So here we see that there is no difference asset liability management. So this can, because this is a small example, it can have a various permutation combination. So just I am showing you how we can do the asset liability management. Now most important techniques, we are coming to external techniques, and normally on which numerical questions are based. In numerical techniques, in this, first is money market hedge. Okay, now how we do the money market hedge, I'm just showing you by way of diagram. Now there are two possibilities. In the future, you have to make some payment, or you are likely to receive any payment. Now here, What you do? Say this is 2 days date. Okay, you borrow in domestic currency the PV of future payment in foreign currency. Borrow in domestic currency equivalent of the PV of the future payment in future currency. Okay. Buy this PV of foreign currency place it in deposit in foreign country, because generally you cannot make the deposit of in the dollar in India. Normal, of course, they are allowed to some for non for special category, say foreign currency non-resident account. They are allowed to maintain the dollar account FDs in India, but for other it is not allowed. We as as a resident, I cannot make the investment in dollar in India. I can make my FD only in rupees only. So if I want to invest or make the FD in dollar, then I have to look for another bank and outside India. Okay. Now interest is accumulated on this amount. This is the interim period. Now in this amount, on this amount, the interest will be accumulated. Koshki is explaining, sir. Explain with the example. Okay, what I will do. I think the question is in your assignment. Okay, Koshki, what I will do, beta? I will refer the example, question number 5 of the assignment number 2. You just first understand the logic, then I will, of course, I will give you a quote to you with the example. Don't worry. Now use deposited amount along with interest to pay the supplier. Okay, because you deposit that much of amount, you just note it down, then I will explain you with the help of an example. Now similarly, when we are expecting this much, so what we do, we borrow in foreign currency equivalent of PV of future receipt. Okay, sell foreign currency acquired above in spot market. Okay, in home currency. Okay, because this amount is converted home currency You invest this amount. This is the same period, 2 days period. After interest accumulation, settle liability, because interest will be accumulated. Sorry, my mistake. Yeah. Okay. Now interest will be student, see, here we have borrowed in foreign currency. Okay. So what will happen? Please see, we have borrowed in a foreign currency. So what will happen? We have to pay foreign bank of interest plus principal with the amount received. So you settle the borrowed amount of foreign currency along with interest, and this interest is in your foreign currency. Okay, this interest is in your foreign currency. Okay, so whatever amount will come to you ultimately, that will be used to pay your loan. Okay, now question, I'm just taking the example that will make more clear to you. Now refer the question number 5 of the assignment. Of assignment number 2. Just refer the assignment number 2 and the question number is 5. Okay, now in this question, I'm just quickly this question, it says the SI Limited and US needs 3 lakh pounds in 180 days. In this connection, the following information is available. Spot rate has been given to you, forward rate has been given to you, and interest rate has also been given to you. A call option also been given to you, rate forecasted. Now, third option is money market hedge. Now, when we talk about the money market hedge, here the party is in US. Okay, party is in US, and after say 180 days, they have to settle a liability of pound 3 lakh. So it means they have to borrow this much of amount. Okay, so what they do, they borrow the domestic currency. Okay, they borrow the domestic currency equivalent to the PV of the payment in future currency. So PV of, because you have to buy this in a deposit here. So what you do, you borrow PV of pound. Pound means you have to pay 3 lakh pound. So what you do, you have to make the investment. You have to make the investment. Now, when you have to make the investment, at what rate it will be make the investment? You will make the deposit in UK at 4.5%. So ultimately, you have to, how much you have to borrow? You have to place this much of amount in deposit. This much of amount you have to deposit, For equivalent to this amount, you have to place in the deposit, and equivalent at the spot rate. Spot rate is our, as on date, it is a rupees 2. Sorry, $2 is equal to this. So accordingly, the amount will $574,162. Now what will happen? You see the course of action. This is dollar amount. This is pound amount. Okay. Now what happens? This is today. What happens? You have borrowed this much of amount, 574,162. Okay. You borrow this amount, buy in the spot market, and place in the deposit this much of amount, 287,081. 287,081. Now after that, interest is added. Here interest is added. Now here the interest will be at the rate of, borrowing rate will be applied. Here it will be interest at a 5.5%, or here it will be at the rate of 5%. The amount will become 287,081 into 1.045. Just calculate it. The amount becomes, friends, 3 lakh pound. Here this amount becomes due. Now what happens? After post 180 days, this much amount you will pay to the bank, importer will pay to the bank, and this much of amount that will be received, that will be used to settle the liability. Okay, so the amount does not come to you, ultimately it is settled outside. This is a very important concern. So here ultimately how much you are paying for 3 lakh pound? The effective rate is okay, student. So now this is a, we can say that it is one of the way. It is, or you can normally it is said that the money market hedge is normally used where no forward contract, where no forward contracts are available. So this technique is used there. Okay, student. I hope it is clear to you how we can use the money market hedge to hedging our foreign exchange risk. Now I am next coming to the derivative instruments. Now these three instruments you have discussed, we have discussed at our in the topic derivative, where the underlying was stock and index. Now here when we discuss this in context of foreign exchange, The underlying is our foreign exchange. Accordingly, first category of derivative instrument is forward contract. Now, when we talk about the forward contract, it can be, we can see that there are two type of coverage in our syllabus. One is from the hedging point of view, and another is we can say that it is from the point of view of the fate of the forward contract. Because what happens, it is not necessary that whenever you enter into a forward contract, you can get the three options. Either you go for delivery, okay, or either you go for cancellation, or you can also ask for the extension from the bank. This is practical. Very typically, this topic is very practical topic, and it normally happens. So in these two categories, we can use first I am covering here for the discussing with you the from hedging point of view. Then I will discuss it from the fate of the forward or execution. We can also call it as how we execute the forward contract. Okay. Now next it comes is our future contract. Now question comes, what is future contract? I can say, as you know, that it is a standardized form of forward contract. It is a standardized form of a standard contract. Now, student, when we attempt the question of future contract, it is very important to note that one important point I am discussing with you. Just a second, very important line. One very important point to note that normally student confuse that like forward contract, we sell the foreign exchange in the market. No, in future contract, we normally carry out the spot transaction on maturity date. Okay. Basically, what happens on spot, well, on maturity, whatever the foreign exchange is coming or whatever foreign exchange we require, we normally get it through our transaction from the spot market. Whereas, how we hedge it through the variation margin. So, dear student, it is very important to note that in the question of futures, normally what happens, we carry out the normal future spot transaction. In addition to that, we carry out the variation adjustment, because variation adjustment means we see that whatever the position we have taken, we have to offset our transaction by our future commitment with the opposite transaction. So this is normally to offset or cancel out or settle the future contract. Sir, do one question on future. Beta, let me see, the time is quite less. Okay, beta, if see possible, I will take small example. I will take the assignment question. I think I can discuss with you. Just 2 minutes. Beta, you can refer the example question number 3 of your second assignment. It is the best example for the adjustment of the future. Now, there are one more questions here. It is question number. There is one more question that I was referring. There is one more question in your assignment. I will just specify the number. Now, please note one more important point that you need to remember: adjustment of opportunity cost of interest. That is very important. Normally, it is skipped out by the students. See, in future and forward, there are nothing kind of a thing of a premium. However, when we enter into the future contract, we have to deposit some margin money, and that margin money I need to discuss with you because it is used for the marking to market. Okay, to counter this is exchange rate rules are there. So in that case, what happens? You have to, whenever you deposit the margin money, you ultimately forego some interest on the same, and that is also factored in the your cost of the future option. Janvi is saying, sir, please provide solution in assignments also if possible. Students, see, most of the questions or solutions are your from study material, but my request to you, please try to write the solutions with your own hands by watching our lectures, because it will enhance your knowledge and it will also give a practice to you. So because if I provide you the solutions, ultimately that is kept aside. Okay, I have seen the solution. No, you have to at least carry out some calculation with your own hands. So prepare your own notes. That is my humble suggestion. Now, adjustment of the this is very important. Now, if I talk about say question number 3, just Janvi is asking. Student, quickly, I am just referring this question number 3. Just refer the question number 3 of assignment 2 so that I can move further. One more important point, student, that I forgot. Now, very important, which position we have to take. Now, question comes. Now, very important thing, which position we have to take. Now, basic rule is that long in underlying, that is, you will buy or you will have a holding this position, then short in future. Okay, student. Now let us see this question. This is question number 3 of assignment 2. Now, very important point here. The exporter is in exporter is Indian. Okay. Now he is likely to receive US dollar 10 lakh. Now what happens? It is very important to note in which currency, in which underlying the contract has been given. Now here in a future contract is in underlying is in rupee. Okay, the future contract is in underlying is rupee. So it means you have to buy. You have to buy. It means you can say that you have to buy. Let us see. What is your position? Your position is short in underlying. Your position is short in underlying means in the future you will receive, you want to convert in, or you can say that suppose if this dollar, I just say you this way, if suppose this contract is, you have future contract is in dollar, okay, this has been in dollar, so ultimately you will go for the short in dollar. But here what is happening, the contract is in Indian rupee, the contract is in Indian rupee, so you have to see what you have to do. You have to go for the long in future. Long in future means that you will buy the future, you will buy the Indian rupees, you will buy the Indian rupees, you will buy the Indian rupees, because it is likely that the when you get it converted, rupee becomes stronger, you will get likely to receive lesser amount. So accordingly, what the position he takes, he buys the contract. Now the how much amount is likely to receive? 10 lakh dollar. Okay, the future rate is given to you, 3 months future rate is 0.16118. Okay, this much amount will be divided by the contract size. So approximately the number will be 25. Now this much contract will be, you will long. This much contract you will long. Now after, now you will pay the variation margin. Okay, variation margin, that will you will pay the margin. Okay, now we'll see margin, how much margin is there. One contract, the margin is 22,500. So ultimately amount comes 5,62,000. This much of the margin money is there. Okay, student. Now what happens? You have bought at this rate. After 3 months, the rate comes 0.16134. You cancel out it. Okay, the contract on this, the amount is 25, and okay, student. Now one contract size is 24,816. So this amount will be come into dollar. This amount will come into the dollar. For getting the amount in Indian rupees, you will use the spot rate 0.16136. Ultimately, the amount comes 615,195. So this is the variation margin. It means it is a gain to you. Now, as I told you, ultimately, you have to carry out a spot transaction at maturity date. Now, at maturity date, you will sell US dollar 10 lakh at rupees 1 divided by, because this is the rate, spot rate. Okay, students, the amount comes okay. So this is your spot transaction. Along with this spot transaction, you will add this gain. along with this spot transaction, you will add this gain from this. You will deduct your opportunity cost of interest because money has been involved for this much of period. The amount comes 9884. Okay, so ultimately receipt will be this much of in Indian rupees. So it is very important that you have to note it is we have to carry out the spot transaction. This is normally confuse the student. Okay, student. Now it is, I hope it is clear to you. Now next comes the topic of option. Now, contrary to your forward and future where commitments are involved, of course, you know that in option there is an element of a choice that you can avoid the transaction. Now, question comes: option contracts are normally used where normally, of course, it is used, but normally it is used where there are three scenarios or there are three categories where normally it is more used, like in international tender. Where you can you may get or may not get the tender. So they are used for the option contracts because you are not sure that this amount, because ultimately, of course, suppose if you have, I'm just saying, suppose you have applied for a tender of say $50 million in any country. Okay, now you have, because you have to ultimately you have to make this you will do the work there and ultimately this payment you will receive. You are expecting this much of amount will be received, likely to receive after say one year. Because now what happens, you are applying for a tender and you are likely to receive. Now in this case what happens, if you enter into a forward contract based on this, it is likely that if you don't get the tender, then you will be in the problem because you will short of the delivery suddenly. So in that case, what do? You opt for the option contract, because if you get the tender, then of course it will benefit, it will work as a hedging instrument to you. And if you don't get the tender, then you can avoid the transaction. Similarly, it can be used in receivable with default or political risk. Okay. Risky investment portfolios. Okay. Suppose you make some investment outside India and say today you have made some investment, say $55 lakh in USA. Now it is likely that if the market goes on well, the amount will convert it into 6 lakh. So if you commit with your banker for the forward that I will give you the supply you the $6 lakh after say 3 months, 4 months. So it might be possible that if the market become weaker, your amount will be left with only 4 lakh. So in that case, the 2 lakh will be the short delivery. So that's why you can use the option contract here. So now, similar to option, the question comes, what position we have to take in an option contract? In this regard, I will refer the question number 4 of the assignment. Please refer the question number 4 of the second assignment. 1 second. You just read the question. Now, in this question, students, please note, you need to pay in Japanese yen. Okay, you need to pay in Japanese yen. An option contract is in INR. Means the underlying of the option contract is INR. So it means to buy INR, to buy Japanese yen, you have to sell INR. Okay. When we talk about the INR sale, it means we have to enter into the put option, because contract is in underlying is in INR. Now suppose if this contract is option contract is Japanese yen, then to buy Japanese are, yeah, 1 second. I like it write it like that. Then we have to enter into call option. Okay, student, if the contract has been given you in the Japanese yen, so it is very important to note, interpret it, because once you you are clear about in which position you have to take, whether in future or whether in option, the problem is battle is half won. Okay, student. So with this, there is another last derivative instrument left is swap. In this case, what happens? Normally, this swap covers your both currency risk as well as interest rate risk. Now, students, because there is a separate chapter for interest rate risk management, there this topic has been discussed in greater detail, but just briefly I am saying. Now, if swap arrangements are in same currency and different basis of interest rate, then it is called interest rate swap, or it has the interest rate risk. Okay. If arrangements are in different currencies, then it is called circus, cross currency interest rate swap. Sometimes it is also called cross currency interest rate swap. So it is it includes both currency as well as interest rate. Reason is that normally what happens, I just give you a very small example. Say there is an Reliance Limited in India. Okay, they are business leaders. And then another company we can talk about, say, IBM in USA. Okay, now in India, if RIL goes to bank for loan, of course, they might be getting a favorable rate. Now suppose, and similarly, if RBM is going to in a bank in USA, they may getting a favorable loan rate. But if Reliance goes to USA bank, they may not get a favorable. Similarly, IBM if come to India and ask for a rupee loan, they may not get a favorable loan rate. Here it is this. So in that case, what they do, they swap their position that Reliance borrow in India, give the money to IBM, borrow the money in USA and hand it over to the India, Reliance. So in that case, they exchange their principals and they re-exchange their principal after the certain maturity period. In between, the interest payment goes on. So this is the method like that. So this is the brief of the our swap. With this, I come to the end of the topic of the derivative instrument. Now I am coming to the most important another topic, fate of the forward contracts, fate of the, or we can say that execution of them. Now here in this category, first I am taking the case of early delivery. See, students, please refer the theory from the study material. It is very easy. Okay, in early delivery, what are the charges are payable? Because swap difference. Okay, student. Now, once you go through the theory, you will get it easily understood. Then cancellation on. See, but if delivery is on due date, then no problem comes. It is very much clear. There is no problem comes. Problem comes when there is a variation in any for commit to meet the commitment of any forward contract contents. Okay, you can refer the illustration number 5. Of study material, where what happens, you enter into the reverse transaction of the original contract and bank charges the money or give back to you the money, whatever be the position. Next comes the early cancellation. Means you want to cancel the contract early. Here the bank is ready to do it, but they say that of course they will cancel the contract and they will enter into a synchronized transaction for the same period. Because ultimately what happens, see what happens, the logic behind all this scenario, all these cases, whenever you enter into a transaction with the bank, on the bank transaction, or you can say bank make a cover transaction with other party in opposite direction. Say you say that I am an exporter, after 3 months I will sell you to $1 lakh. So ultimately what happens, the bank looks for another importer who needs $1 lakh after 3 months. So they enter into a cover transaction with that importer. That bank will sell to them $1 lakh, whatever the dollar that will receive from you. So normally all these questions are based on that logic, because now if you say you come to the bank 1 month before, say that I want to cancel the transaction after 2 months, bank will say okay, no problem, but I will have to incur some losses because of you, because I have committed other person to that I will sell to him $1 lakh. So what I will do today, as on date, I will enter into a forward transaction for the 1 month. So this difference you have to make me out. That's the logic behind the same. Now next is extension on due date. It is similar to cancellation plus new rate, new forward rate. This is question number 2 of assignment. Second. Same as early cancellation plus new forward rate. Now another case I'm coming to here is late delivery, cancellation and extension. फिर एसी ठीक करवाओ यार, हाँ एसी का टेम्परेचर गर्मी लग रही है बहुत ज्यादा मेरे, है ना, बोल देना 5-10 मिनट और रह गया यार फोन से तो. Now student, here note that here the rule 6 of FIDI will apply. Okay, rule 6 of the FIDI will apply, and here there are some, because very important point here you have to note that in case of late cancellation, in earlier 1 to 5 cases, first to 5 cases, if any loss, please note down this line, it is very important line. If any loss is there, bank will recover it. If any gain is there, bank will pass on the same. Okay, if any loss is there, bank is there, and if it will pass on the same to the customer. Now here, in case of 6, losses will be recovered, but none of the gain will be passed on to the customer. It is very important. If any loss is there, then it will be recovered, but if any gain is there, it will not be, none of the gain will be passed on the customer. Okay, student. So there is illustration number 9. In the study material, please refer the same for the same question. Here just I am just pointing out there are some issues student normally face. They say, sir, what is exchange difference? Student, what happens? Because bank, since bank has to see, as I told you, the bank is normally enters into cover transaction. So in the this question in the study material, the customer is an importer. Okay, and ultimately banker has entered into with another exporter. So if it does not turn up the importer, the exporter will sell the currency to the bank, and bank ultimately will have to sell into the market. So all this has been covered here. What are the main here topics? Exchange rate difference, or you can say another charges are swap loss. That is normally arise on account of, you can say, it is kind of a forward transaction loss. We can say that normally it is because it is normally used to write off the entry. And third is interest on outlay of funds. So these three consist of your mainly the charges as per rule 6 of the day. Now student, I'm coming to the last but not the least. There is one term, non-deliverable forward contract. One more item is left, Nostro and Vostro account. Now non-deliverable forward contract means normally their transactions are not in this, there is no delivery of the currency, it is not, nor it is taken, rather they are settled in cash. Recently what happens, Dubai used to be considered a very important center for the non-deliverable rupee contract, but now recently government of India or RBI has come out that now in Gift City at Gandhinagar, now NDF will be in rupee will be traded. So by this this offshore non-deliverable has become inshore NDF. Now the main benefit of is that to the government is that now due to this there will be no loss of the foreign exchange to the government. In the end, I am coming to the one more last important topic. Nostro Vostro Loro account. Okay, Nostro account means our account in foreign currency with you. Your account in home currency with us. And Loro, not Loro, it's Loro. Their account with you. Okay, now suppose PNB maintains account with Citibank in New York. So this account in Citibank, this is in dollar, is Nostro account for PNB. Now suppose SBI maintains rupee account for HSBC London. So this will be the Vostro account from the viewpoint of the SBI and Nostro account from the viewpoint of the HSBC. And their account with you means, suppose PNB maintains dollar account with Citibank New York. Now from SBI point of view, this account will be termed as a lower account because PNB's account with Citibank London, Citibank New York. So when we talk about the questions, student, when we talk about this Nostro account, there are one very important point I am here discussing. There is cash position and another is exchange position. Now please remember one thing. All cash position will be affect any transaction in a cash, like say transfer of funds, etc., will affect the exchange position. Whereas it is not necessary that all cash position may affect the cash position. The reason is that, for example, that's why I give you. For exchange position, normally forward transactions are covered. Any commitments are covered. But in cash position, only transfer are covered. So it is very important. Once you understand this, note the difference, the answering of the question will be very easy for you. So with this, student, I'm coming to the end of my today's session. And as you know that it is usual practice. If you have any query, please write us to at our okay, student, sfm-finance@.icin. You can carry out in small. And our contact number. So you can discuss with me, you have any doubt. And with this, we come to the end of the topic of the foreign exchange exposure and risk management. Student, please, it is very important to note that instead of cramming the question in this topic, you understand the basic concept behind the same, then any type of question comes into the examination, you can solve. Okay, student, thanks for patience listening and practice as much as you can do. And with this, I'm coming to the answer session. And very important, last, very not in list, please don't ignore the topic of this theory topic also, theory of this topic also, because they can also be come into the examination. Okay, student, have a nice day. With this, we end this session. Thank you. Have a nice day. Okay, on over.